some of the largest stocks. Dipan Mehta now joins in. Dipan, hi, good morning. Good to have you on the show. Now, your favorite theme has been IT for last few months. It's become a bit volatile, especially TCS, ever since its numbers. How would you approach a stock like that?
Yeah, I think we were quite pleased with the results declared by TCS, and although street and analysts had higher expectations, given the size challenges and given the base effect, I thought the company did pretty well, landed to get 50% kind of a bottom line growth. And also I think the body language of the management was extremely strong, and they look towards the future with a lot more confidence. So my sense is that TCS and the entire IT pack should do pretty well over the next 12 months. I think 2014 could be a great year for them, given that the dynamics of the industry are improving. We are seeing global growth take off. And I think what we noticed this time around is that a lot of revenue growth has also come through from Europe, which means that one of the major markets for the IT companies, which was not in a growth phase at all, rather was just stagnant or declining, that seems to have been picking up for the IT companies, and that I think is pretty positive. Also, some of the laggard sectors also seem to have come into their own. So my sense is that there is volatility in earnings as far as mid-cap IT companies are concerned, more to do with the forex gain and losses which they have booked. But by and large, I think the results have been pretty much decent for most of the companies in the IT sector.
Okay, Dipan, thanks for joining in this morning. Your view on the FMCG space? We've seen Asian Paints decline for the second day running. We have some trepidation which has come into ITC as well. Today, it's down 1.7%, especially on Asian Paints post its numbers. Would you have a view on FMCG and Asian Paints?
See, I think a lot of the consumer-oriented companies, Asian Paints included, and then we also saw TTK Prestige, which came out with rather dismal set of numbers. And then you look at Emami as well, growth top line was a bit disappointing, although bottom line was great on account of cost savings. And then there is of course Colgate and ITC, which also came out with results which are lower than what we have been used to seeing for the sector as a whole. And the reason for that is that I think the slow economic growth is finally affecting even the consumer-oriented and the FMCG companies. Cost increases led by inflation are eating into profit margins. And although the companies have been doing as much as they can in terms of improving their internal efficiencies and keeping their profit margins intact, there is only so much that managements can do. And I think the effect of high inflation and slow growth, which we have been witnessing for the past several months in India, is finally showing up in the results of the consumer-oriented and the FMCG companies. And this could be, I think, the way forward for next few months as well, till we don't see that entire GDP growth rate moving up from around about 5% or thereabout to at least 6.5% or so, or interest rates have to come down, consumer spending has to look up. See, as much as these companies could do out of the rural markets, they have been flagging that horse and trying to get maximum mileage out of it. But then I think base effect also tends to catch up over there as well. And I think those are the problems which the FMCG and the consumer-oriented companies are facing at this point of time. And my sense is that looking at the early results which have come through, it may be a good idea just to remain slightly underweight or equal weight in the sector. No doubt long term is great, but I think in the medium to short term there will be challenges and the sector could be an underperformer.
Dipan, what about the market itself? Because there's a bit of fatigue which is set in at higher levels. The Nifty is just not able to break past its previous highs. Do you think it's lacking triggers or is it just consolidating? And what's your own call on the market for the rest of the year?
See, I think one can give a call only up till the election results. It should be out sometime first week of June. And I think that we have to pair our optimism and bullishness a little bit looking at the numbers which have come so far. And I would say that the quarterly results, at least the early ones, are not that encouraging. Sure, a few IT companies have delivered, like HCL Tech delivered better than Wall Street was expecting, but and maybe in Infosys for that matter. But if you look at the banks, some of the NBFCs which have come out with results, a lot of the IT companies, second-tier IT companies, the FMCG and the consumer-oriented companies, all of these have been, disappointing. It's not that the numbers are not bad per se, but the stocks have run up significantly over the past 3 months and expectations are running high. I think after a long time we are going into earnings season on a bit of a high as well, with a lot of stocks trading at their all-time of 52-week highs. And then when companies are not meeting their results, we are seeing sell-offs taking place. So keeping in mind that this earnings season, although on paper may appear to be good, but in actuality in terms of meeting expectations may fall a bit short, you have to factor in that the markets would trade around these levels, maybe slightly lower as well. And one shouldn't bank on an absolute breakout and going into fresh territory, or going beyond that 6,500 nifty levels or so. It's a bit early in the earnings season, but my sense is that some more of this sideways movement is what could be expected till about next 2-3 months or so. And then come March, April, we go into the the election fever, and then maybe RBI policy of those months will also be quite critical, because they would have 2-3 months of benign inflation. So whether they intend to cut interest rates, my sense is that the trigger for the market has to be only twofold. One is a good election result, and second is a cut in interest rates by RBI whenever it comes through, maybe second half of the year or even earlier than that.
Okay, Dipan, would you have a view on Ashok Leyland? Because the conference call is currently underway, and we can see that they are possibly even cutting down on capex going forward quite aggressively. Their working capital has reduced, and despite that EBIT loss which they've recorded for the first time in history, and that net loss that they've recorded on the bottom line, the stock is up 2%. Would you have a view on it, and would you peg it as a possible turnaround story in 2014?
Not really. I think Ashok Leyland bears the full brunt of the slowdown in the automobile industry. Unlike its peer group like Tata Motors, which has got Jaguar, or Eicher Motors, which has got Royal Enfield, and then it's got its JV with Volvo, and then there's M&M, which has got also farm equipment, tractors. So given that it's not as diversified an auto company as some of its peer group, it's facing the full pressure of absolute complete slowdown in the commercial vehicle market. And although on valuation basis, historical parameters does appear to be cheap, I think we need to buy the stock only when we are convinced that we have seen a turnaround in the commercial vehicle industry, and that is closely linked to the economic growth trends over here. So I mean, Ashok Leyland now has become a perfect play on the GDP growth rate of India, pickups in the capex cycle, improvement in mining, power, etc. And until that doesn't take place, I think it's best to stay away from the stock. And such minor upticks may come through depending upon what the management has to say. But I don't see it really, putting the stock markets on fire in any time in the near future.
All right, Dipan, thanks very much for joining in. So that's the view coming in on the market by Dipan Mehta for